Sridhar Sivaram joins us now. Last time when we met him, he exactly wasn't smiling.
So even last time I said the broader market's looking very interesting. I say the same, that the broader market's looking very interesting. These are times to actually evaluate a lot of the stocks that have had collateral damage. Stocks have corrected massively, and do your extra homework, because if you don't do that, you could burn more of your cash. But these are really interesting times.
Okay, I have a very basic question, which is that without getting into specifics of what will happen to which bank and which NBFC, there is a concern that the Indian financial sector is not very robust.
Right.
Years ago, the concern was NPAs. Now it is about survival of some NBFCs and some private banks.
Sure.
A DHFL stroke IL&FS crisis broke the back of the market and the economy.
Sure.
If anything goes wrong with a private bank or a private NBFC or two private NBFCs,
Sure.
what happens to the market then?
So, I may sound like a broken record, but I've been speaking about this for 2 years now, that the problem is emanating from the HFC. So we call this an NBFC crisis, but look at all the names. They are all HFCs.
So true.
And where does the problem come from behind? It is the real estate. So my big concern is that for the HFCs in general, the reporting requirements have been very poor. I mean, they can restructure an asset and not disclose to minority shareholders or even to, the banks. So I have been, at least there have been many people who've been advocating that we should have an AQR. From what I understand from governors' interviews, that they don't have the bandwidth right now to do an AQR. So my second suggestion is that if you don't have the bandwidth, at least make disclosures more stringent. Let them disclose all the restructured assets. Let them at least disclose their top 10 exposures to corporates. If you just increase the exposure, I think the market will do the AQR on its own. So I think my concern remains that HFCs are the pocket, and especially given the fact that there was a data which I recently got that in the last 5 years, 85% of incremental real estate lending has happened through HFCs and NBFCs. That number is roughly 2 lakh crores. Now, I'm not seeing any NPAs significant enough for a 2 lakh crore lending in any of the HFCs combined put together. If I look at banks, 25% of their real estate exposure is roughly stressed. For an HFC NBFC, I hardly find it, the number is 1 to 2%. I'm like, there's a big disconnect here. So I think if there's an information arbitrage here, we don't know what is happening in the books, and people suspect. So the fact that some of these stocks are correcting, I'm not surprised, because we don't know and people are suspecting the worst.
Yeah. We were talking about in the morning, the universe has conspired for India to get it right finally,
Sure.
or at least the markets.
Sure.
You have the corporate tax cut, you've got disinvestment, you've got crude under control, everything
Yes.
is fine at Saudi
Yes.
Aramco now. What could spoil the party? And more importantly, from here, how long before real consumption actually comes back?
Yeah, so actually I'll take the last question
Sure.
first, which is on the consumption part. So if I look at what the government has done, the easiest thing for them would have been to do a fiscal stimulus for consumption.
Yeah.
We would have got immediate results and everybody would have been cheering. They've taken the harder route, which is, do a fiscal stimulus, but for investment. So you go back to the economic survey and you read, they keep speaking about how investment-related growth is far more sustainable than consumption-related. I tend to completely agree on that. Government has taken the harder route. But I think this, on a medium to long term, this is going to be more sustainable than, say, the government had done a GST cut for a particular sector or something like that. We would have got a one-time blip or a one-time pop, and then it may have fizzled out. So in my view, maybe another 6 months, because by then the base effect will start kicking in. But I'm very happy that the government has taken the hard route. And for long-term investors, this is a very good sign that, one, the government is taking certain structural reforms which are long-term, medium to long-term in nature. Plus, they've taken the other route, which is the privatization route, which is what we've all been talking about for 20 years now. Finally, we are seeing some light at the end of the tunnel.
You mean to say 6 months before volumes for staples, autos, everything comes back?
I think it will. No, the base effect kicks in. Keep in mind that last year, roughly at this time is when IL&FS crisis started.
Yeah.
And the worst of the numbers were the fourth quarter of the last financial year. So when you get into the fourth quarter and the first quarter of next year, we are basically having a lower base effect. We do think that some of the investment-related changes that the government has done will take at least 12 to 18 months to actually see clear impact on the economy or in terms of investments. We do think that the first round may be FDI related, which is the domestic companies are already, the capacity utilization 65-70%. Nobody needs to put capacity. But there is opportunity that some of the global players may look to shift their manufacturing base from China. So that's a huge opportunity, but it will not happen overnight. So this may take some time. Till 15 days back, we were not even in the short list of countries. I think surely today we are right at the top, provided the other ease of doing business is taken care of.
What are the chances, and again, I really hope that does not happen, that all the attempts from the government, which are applauded right now, they may not translate into big bang earnings pickup. And I'll give you an example. When banks were recapitalized 2.5-3 years ago, we all thought the lending activity would start. The pain in the banking sector will come to an end, and we could be staring at a new dawn because banks will get capital to lend. Look at what's happened. They've used all the capital to write off.
Yeah.
So my question to you is that tax cut on paper is great, but what are the chances corporates may not spend? They may retain tax cut.
Yeah. So I think what was not anticipated was the collateral damage of an IL&FS crisis. Let's face it, after IL&FS crisis, we've had one after the other because the funding to many of the NBFC, HFCs have got crunched. As a result, many of the NPAs are now coming out. So in my view, what has happened, there are some benefits to this crisis, and I just hope that this crisis is not wasted. The government and the Reserve Bank use this to clean up and to do some more reforms, especially on the HFCs and the NBFCs, especially on the reporting side. We've discussed this before, but I think that is one of the reasons why the whole thing hasn't worked. So I'm still quite optimistic that even though it looks like we have too many clouds around, we don't know what is going to happen on the financial markets in general, whether consumption will recover or not. I'm reasonably optimistic that we'll cross over this wall of worries and move to new markets which will move higher in the next year.
Okay, that's all on paper. As an investor, what do you do?
Well, the same as I said on paper, which is these are really interesting opportunities. Broader markets have corrected 50, 60, 70%.
But you'd be willing to jump in. And I'm
already jumping in.
Yeah, like you're talking about pockets which have been very beaten down and which everyone's averse
I said that 2 months back also. Even now, I'm saying. So I started in the markets in 94. And 94 to 99, the markets did nothing. 4,000 index. In fact, index was at 4,000 from 99 to 2003, barring a brief blip between 2000 when there was a tech boom. But broader markets did nothing till almost for about 8-9 years. So I'm just saying that I started in a bear market, that it's very difficult to make me bullish. So I do find that these are very good opportunities.
So we have a couple of things going to happen in October, right? If we keep the festive cheer apart, we've got earnings that are going to start kicking in. We've got the trade war talks of global markets that may play havoc. Oil is still sort of a borderline. We don't know yet exactly whether it'll play any kind of, whether there's enough risk there or not. But there are a lot of moving pieces at this point. Divestment is a big one. And despite all the positive rhetoric, let's see how quickly they move on this. Given all of that, is there bound to be volatility this month? And I'm just talking from a retail investor point of view, because when they jump in at those lower levels, when they see volatility, they get incredibly nervous.
So for a retail investor, there is going to be bound to be massive volatility. So my view is that for a retail investor, a SIP or a mutual fund is the best option. For other investors who understand the market, I mean, these are good times. All that you mentioned, they're all positive from a macro standpoint. So if there's going to be rate cut, or if there is a trade war between China, India's opportunity to attract some of the businesses go up. Earnings will go up, at least optically, because of tax cuts. So even though the top line might not grow, finally the bottom line will show up, because we will have 2 quarters of adjustments in just 1 quarter, given that companies will have to pay lower tax. So optically your earnings will look better. Having said that, markets have already adjusted for some of the earnings upgrades that may come through. So most of these are positive, but I think the markets will be looking for further improvements, especially on the top line, how consumption moves. I think that's at least 2 quarters away.
Markets are no longer oversold. We've seen an 8%, 9% run on the Nifty, 10, 12% run in the mid in the small cap indices. Yeah. For markets to go higher now, either it's going to be a lot of liquidity, which is not going to happen magically, or we need a big surge in earnings.
Yeah.
Where are you betting or laying your bets on an earnings recovery? Where do you think markets think earnings will not be there, but your analysis is showing earnings would be there? And let's be specific here. Theme, ideas, would you like to call out something for us?
Yeah, so let's look at, say, autos, for example. Okay. We think it's a cyclical slowdown, especially, say, two-wheelers. Okay. As a result, many of the auto ancillaries, which have also got killed. Now that this entire thing about GST, no GST is set to rest, now we are seeing auto companies spending money, advertising, offering cuts.
New launches?
Yes, new launches. One of my issues with the auto companies was that this is a sector which had made so much money in the last 5 years, yet they were crying the most about
cash
slowdown.
balance sheets.
Yeah, and they were crying the most that we need the maximum 10% GST cut we need, otherwise we'll die and stuff like that. Now that they realize that all this is not happening, now they're looking at, what is the next option, which is something which they should have done 6 months back, which is give offers to customers, induce them to buy. Sure. I mean, if Amazon and Flipkart can get outstanding sales in just 2 days because of offers, this could have happened even for them. So typically in a cyclical slowdown, you have to induce customer, and these things turn. And once it turns, we've seen in the past 5 years, these companies have made outstanding, margins, profits for shareholders. And I'm sure shareholders understand. So my view is that these are some of the sectors that I would, surely look at, where if the cycle turns, you'll have disproportionate earnings. Keep in mind that inventory level at the wholesale, which is at the company level, is decreasing sharply. At the retail is reducing, but you're seeing wholesale numbers being very poor because the companies are shutting down production. Once the whole cycle turns, there's very little inventory in the dealer level because that is shrinking as we speak. And the company and the entire value chain has also shrunk. So when it turns, suddenly you will want to have 30, 40 days of inventory. So the whole thing will turn very fast. Yeah. So it's an optimistic assumption. I don't know when it will happen, but we do think in 2 quarters' time, things will start to look interesting.
But is it wiser or more prudent to be market cap agnostic? Because there are the quality companies, they may not be the right valuation or the right market cap right now.
Yeah, so it depends on, how large your portfolio is. So if you're running $1 billion portfolio or more, then some of the very small companies, how much can you buy? So it's a question that you may want a small percentage in your portfolio and it can give you a disproportionate return. But does it make a meaningful return to your portfolio? Maybe no. It may look great just to give a case study that, hey, I bought a stock at 10 and it went to 100.
Okay, some data which you have looked at much more than what we've done, but we looked at the metals data yesterday, which is that they're nearing half-time book.
Yes.
Big ones.
Yeah.
What I know from old timers is that when metal stocks are nearing half-time book or 0.7
best time
book,
to buy.
Best time to buy.
Yes.
Have I answered the question in itself?
Yeah, I've answered. Best time to buy.
Best time to buy.
But it takes some patience as far as this is concerned. Roughly at around 0.7 to half-time book, they start to look very interesting. You can go back to 20 years of cycle. So I remember in the previous cycle in 2003, we had done similar exercise, and it had worked very well even then. But things are changing these days, so I'm not sure if it'll work exactly to the T, but it is an option one should consider. And you need patience for this.
Let's look at the data. Actually, we looked at the data yesterday on the Morning Masala as to what the current price to book of some of the metal stocks is. So when stocks near half a book or quarter time book, you are not looking at whether it's ferrous or non-ferrous. You're not looking at whether it's a local player or global player. You just buy because they are available below the replacement cost.
Yeah, the only caveat I'll make is you need to just analyze the balance sheet a bit. If it is very over leveraged, then you have other issues cropping up. So you have to just look at the balance sheet. You have to do your homework a bit more than what you would normally do. But it's a matrix which works reasonably well.
2003 and 2008, if you bought infra, if you bought asset owners, you made money. 2009 or 2010, starting 2018-19, if you bought NBFCs, or you bought consumer names, not NBFCs now. I'll take it back because NBFCs only few have made money now. You made a lot of money by buying quality. it's 2019. If somebody has to pick up a trend cycle, which is what markets do, they'll follow a trend, they'll follow a cycle. Where would you lay your bets?
I'll buy large cap banks.
Large cap banks.
Because the entire...
But they are banks, these banks are available at...
Not all of them, right?
Right.
But I'm agnostic to valuation at this stage.
Okay.
Because I think the entire opportunity set for them is opening up because the NBFC, HFCs are literally falling off. PSU banks are struggling right now because of the merger and stuff like that. And as the economy turns, these guys will have huge opportunities. Many of them have raised capital. So I don't think capital is a constraint anymore. So I think this is a space that looks very interesting. And if the economy is turning and we get a capex recovery in, say, in 2 years' time, they'll be very well placed.
Are you talking about the corporate banks?
Yes, corporate banks. But none of them are corporate anymore because all of them have 50% as retail. So it's unfair to just call them corporate banks.
It's a wrong classification.
What's your take on the divestment drive? Optimistic? Big bang?
Yeah. So actually, before this, we had actually done a detailed study on divestment. So we had put all the PSU stocks on a spreadsheet, and we said, oh, okay, if the government were to sell up to 50% on all of them, what is the amount they will recover? This was 15 days back.
Sure.
So the number was 1,35,000 crores, by the way. And then we said, okay, let's add Suti to it. Let's add Hindustan Zinc to it. So we have everything in it. That number came to about 2,05,000 crores. Keep in mind that the budget is 1 lakh crores for them.
Yeah.
So which means that in 2 years' time, the government would have, this is if you sell all the stocks, which is not a possibility at all. So they were literally pushed to the wall, and they had to do this because if you are going to do fiscal stimulus like the way they have done, you need to balance the budget in some ways. Okay, you can do a 50 basis points, 70 basis points of fiscal stimulus, but what about next year? So I think this is a step in the right direction. The intention of the government was always there. So if you go back to, say, Air India, they did try. So the intention was there. Maybe the methods were not exactly right. I think they've learned from some of the earlier mistakes, and this time they've chosen some of the best companies. So if you ask me, the top 3-4 companies of government which are very well run, I think BPCL and Container Corporation would have been in the top of the list. So I think they're selling some of the best companies. I think it will do very well if they.
It could light up the fire. I mean, it could light up the fire for the market.
Surely. I'm very bullish on both the companies. They're actually really well-run companies.
Yeah, okay. Appreciate your time. And next time when we meet, I hope that you even have a bigger smile on your face.
Sure.
Where's the next Big Cat Safari, though?
Oh, I was supposed to go to Pench on Friday, but a lot of the parks have shut because of the excessive rainfall.
Yeah.
So I'm going to Chipland to view some exotic birds. Once I get the birds, I'll send you the pictures.
Do that.